A disclaimer, this video is for educational and informational purposes only. The content shared here is based on personal opinions and general financial knowledge. I am not a certified financial advisor. Please do your own research or consult a qualified financial professional before making any financial decisions. The creator of this video is not responsible for any profit or loss incurred based on the information provided. Investments are subject to market risk. The vaults that back every silver futures contract in America. The vaults that underpin the entire paper silver market. The vaults that tell the world there's enough metal to meet every promise. They're not just low, they're collapsing. 73% gone. Vanished from COMEX registered inventories in the last 36 months. And nobody on financial television is saying a word. Last week, registered silver hit 29.8 million ounces. I mean, that sounds like a lot until you realize the open interest, the number of outstanding contracts betting on that silver, represents over 600 million ounces. That's a 20-to-1 paper-to-physical ratio. 20 claims on every single ounce that actually exists. And it gets worse. Yesterday, JP Morgan moved another 1.2 million ounces out of registered and into eligible, out of the deliverable category and into the we're just holding this category. They've been doing this quietly for months, moving metal out of the pool that backs contracts, reducing the available supply while the world isn't watching. The clock isn't ticking. It's already past midnight. Because here's what nobody on Wall Street wants you to understand. Silver isn't just a precious metal anymore. It's an industrial necessity. Every solar panel needs silver. Every electric vehicle needs silver. Every smartphone, every missile system, every medical device. The green energy revolution runs on silver, and we're running out of the stuff. The question isn't whether the silver market breaks. The question is whether you're positioned before it does. And based on what I'm about to show you in the next 18 minutes, you might have weeks, not months, to figure out which side of this trade you're on. Welcome to Finance Market News. Now, before we dive into the vault data, before I show you the exact numbers that the mainstream financial media refuses to cover, I need to ask you something. Are you subscribed to this channel? I know, everyone asks. Every video, someone's begging for subscribers. But here's why it matters for what we're about to discuss. The information in this video comes from COMEX vault reports, from LBMA published data, from SEC filings, from mining company quarterly reports. It's all public. It's all available. But it's buried. It's buried in footnotes and appendices and regulatory filings that nobody reads. The financial news networks won't touch it because their advertisers include the very institutions moving this metal around. So if you're the kind of person who wants to see what's actually happening in these markets, not the sanitized version, not the everything is fine narrative, then hit that subscribe button. Turn on notifications. Because when this situation accelerates, and it will accelerate, you need to know before the headlines catch up. And while you're at it, drop a comment below. Tell me, do you own physical silver, paper silver through an ETF, mining stocks, or are you still watching from the sidelines trying to figure out if this is real? I read these comments, I respond to them, and I structure future videos based on what you're asking, so make your voice heard. Now let's talk about why 73% of America's deliverable silver has disappeared and what happens when the remaining 27% gets claimed. To understand why the current situation is unprecedented, you need to understand how the silver market actually works. Not the simplified version they teach in economics class, the real version. The version that explains why paper prices and physical reality have started to diverge. The COMEX, that's the commodity exchange, operates as the primary futures market for silver in the United States. When you hear someone talk about the spot price of silver, they're typically referring to the price derived from COMEX futures contracts. These contracts allow traders to buy or sell silver for delivery at a future date. But here's the first thing they don't explain clearly. Most of these contracts never result in actual delivery. Somewhere between 95% and 99% of all silver futures contracts are settled in cash. Traders roll their positions forward, take profits or losses in dollars, and never touch a single ounce of physical metal. This creates a system where the paper price, the price determined by futures trading, can diverge significantly from the physical price, what actual silver costs when you try to buy it. The COMEX maintains vaults to back this system. Metal in these vaults falls into two categories, and this distinction matters enormously. Registered silver is metal that's available for delivery against futures contracts. It's been inspected, certified, warranted. It has an owner who has explicitly made it available to fulfill contract obligations. When someone stands for delivery on a futures contract, registered silver is what they receive. Eligible silver is metal that's stored in COMEX vaults but is not available for delivery. It's there, it's real, but the owner hasn't made it deliverable. They're simply using the vault for storage. This distinction explains something crucial. When you hear that COMEX has 300 million ounces of silver in its vaults, that's the total. Registered plus eligible. But only the registered category backs the futures market. Only registered silver can satisfy delivery demands, and registered silver has collapsed. Let me give you the numbers. In February 2021, COMEX registered silver peaked at approximately 152 million ounces. As of last week, that number has fallen to under 30 million ounces. That's not a 73% decline. That's actually an 80% decline. The 73% figure in this video's title is conservative. 4 out of every 5 ounces of deliverable silver have left the registered category in just over 3 years. Where did it go? Some transferred from registered to eligible, meaning owners decided they no longer wanted their metal available for delivery. They're keeping it, hoarding it, removing it from the pool. Some left COMEX entirely, shipped to vaults in London, in Singapore, in Zurich, moved to locations where it can't be claimed against American futures contracts, and some was delivered, actually claimed by contract holders who stood for physical metal instead of settling in cash. This last category is the most telling, because in a normally functioning market, very few people actually take delivery. The futures market is designed for hedging and speculation, not for acquiring physical metal. When delivery rates start climbing, it signals that trust in the paper system is eroding. In 2024, delivery rates on silver futures increased significantly. More contracts than expected demanded actual metal. Each delivery reduced the registered pool. And unlike gold, where mining production can respond to higher prices relatively quickly, silver has a problem. 2/3 of all silver comes as a byproduct of mining other metals: zinc, lead, copper, gold. You can't just mine more silver by opening silver mines. You have to mine more zinc and hope silver comes with it. This makes silver supply remarkably inelastic. Prices can double and production barely responds because production depends on demand for other commodities. So we have a situation where paper claims on silver vastly exceed physical supply, where that physical supply is declining, and where production can't easily increase to meet the gap. The financial media calls this a technical situation. Traders call it a structural imbalance. But what it actually is, stripped of jargon, is a game of musical chairs where 20 people are circling one chair and the music is getting faster. The question that keeps institutional analysts up at night is simple. What happens when too many people try to sit down at once? Here's where the silver story separates from every other precious metal narrative. Gold is primarily a monetary metal. Yes, it has some industrial uses, electronics, dentistry, a few others. But the vast majority of gold demand comes from investment and jewelry. Central banks buy gold. Investors buy gold. The industrial component is relatively small. Silver is different. Silver is schizophrenic. It's both a precious metal and an industrial commodity. And right now, the industrial side is exploding, while the investment side is just waking up. Let me walk you through the industrial demand picture, because this is what the mainstream financial press consistently underreports: solar panels. This is the big one. Every solar panel requires silver. Silver paste creates the electrical pathways that allow solar cells to capture and transmit energy. There is currently no viable substitute at scale. Other materials have been tested: copper, aluminum, various alloys. None match silver's conductivity and reliability. In 2020, the solar industry consumed approximately 100 million ounces of silver. In 2023, that number exceeded 160 million ounces. In 2024, estimates suggest solar demand alone exceeded 200 million ounces. And the International Energy Agency projects solar installations to continue growing at 25-30% annually through the end of the decade. By 2030, solar panels alone could require 300 million ounces of silver per year. That's roughly 1/3 of current total annual silver production, just for solar. Electric vehicles. Every EV uses more silver than a traditional internal combustion vehicle. The electrical systems, the contacts, the charging infrastructure. A typical EV contains approximately 1 to 2 ounces of silver. That might sound small until you multiply it by the tens of millions of EVs expected to be produced annually by 2030. 5G infrastructure. The rollout of 5G networks requires silver in antenna systems, circuit boards, and transmission equipment. Every 5G base station, every compatible device, every piece of network infrastructure adds to silver demand. Military applications. Silver is essential in missiles, torpedoes, submarines, and aircraft electronics. Defense spending is rising globally. Every geopolitical tension increases silver consumption in ways that rarely make headlines. Medical uses. Silver has antimicrobial properties. It's used in wound dressings, medical devices, hospital equipment. As healthcare spending rises worldwide, medical silver demand grows with it. Now add all of this together: solar at 200+ million ounces, industrial electronics at 150+ million ounces, photography, brazing, and other traditional uses at another 150+ million ounces. Investment demand fluctuating but averaging $100, 200 million ounces. Total annual silver demand is now exceeding 1.2 billion ounces. Total annual silver production, mining plus recycling, is approximately 1 billion ounces. Do you see the problem? For the past several years, the silver market has been in a structural deficit. Demand exceeds supply. The difference gets made up by drawing down existing inventories, by pulling metal out of vaults, out of ETFs, out of wherever it's stored. The Silver Institute, the industry's primary research organization, documented a 140 million ounce deficit in 2022, a 142 million ounce deficit in 2023. Preliminary estimates for 2024 suggest another deficit exceeding 150 million ounces. 3 consecutive years of deficits, over 400 million ounces drawn from existing stockpiles. And COMEX registered inventories have dropped by over 120 million ounces during that same period. Coincidence? The silver market is consuming its own reserves. Like a company burning through cash to maintain operations, the silver market is drawing down the physical metal that backs the entire paper trading system. And at current rates, the mathematics becomes uncomfortable very quickly. Let me put this in perspective with a historical comparison. In the late 1970s, the Hunt brothers attempted to corner the silver market. Nelson and William Hunt accumulated approximately 100 million ounces of silver, representing roughly half of the world's deliverable supply at the time. Their buying drove prices from around $6 per ounce to nearly $50 per ounce in a matter of months. The government intervened. The COMEX changed its rules mid-game, implementing liquidation-only trading that forced the Hunts to sell. Silver crashed. The Hunts went bankrupt. But here's what's different now. The Hunts were 2 wealthy individuals trying to manipulate a market. They were visible, vulnerable, subject to regulatory pressure. Today's silver shortage isn't caused by manipulation. It's caused by fundamental supply-demand dynamics. It's caused by the green energy transition consuming silver faster than it can be mined. It's caused by decades of underinvestment in silver mining because low prices made exploration uneconomical. You can't pressure solar panel manufacturers to stop using silver. You can't pressure EV makers to find a substitute that doesn't exist. You can't pressure 5G networks to use less silver in their electronics. The demand is real. The shortage is real. And unlike the Hunt brothers, there's no villain to stop. There's just math. If you've been paying attention to the silver market over the past few years, you've noticed something strange. The spot price, as reported by financial media, often diverges from what you actually pay when you buy physical silver. Walk into a coin shop, try to buy Silver Eagles or Canadian Maple Leafs. You'll pay what's called a premium over spot. In normal times, this premium is 5 to 10%. During periods of high demand, it can explode to 30%, 50%, even 100% over the paper price. In 2021, during the Wall Street silver movement, premiums on retail silver products exceeded 50% at multiple dealers. People were paying $35, $40 for silver when the spot price was $25. And the dealers couldn't keep product in stock even at those premiums. Why does this happen? Because the spot price isn't really the price of physical silver. It's the price of a contract, a promise, a paper derivative. And when people start questioning whether those promises can be kept, they're willing to pay more for actual metal. The LBMA, that's the London Bullion Market Association, operates similarly to COMEX, but in London. Together, these 2 markets set global precious metals prices through trading that is primarily paper-based. In early 2021, the LBMA reported that London vaults held approximately 1.1 billion ounces of silver. That sounds enormous, but when observers started questioning those numbers, something interesting happened. The LBMA changed its reporting methodology. Then it adjusted its figures. Then it acknowledged that a significant portion of that silver was actually double-counted, metal that appeared in multiple categories. Revised estimates suggested actual physical silver in London was substantially lower than initially reported. Some analysts estimated the real figure at closer to 800 million ounces. Others suggested it was even lower. And here's the issue with both COMEX and LBMA numbers. We're trusting the institutions with the most to hide to accurately report how much metal they hold. There are no independent audits, no physical counts verified by third parties, just self-reported data from institutions that profit from maintaining confidence in a paper system. In 2024, something unusual happened that highlights this trust issue. Multiple silver ETFs, including SLV, the largest silver ETF by assets, reported significant outflows of physical metal. The ETF was shrinking. Investors were redeeming shares, and the fund was delivering silver to meet those redemptions. But the silver didn't just disappear. It went somewhere. And increasingly, that somewhere was out of the transparent, reported Western markets and into the opaque vaults of Asia. China has been accumulating silver aggressively, not through public announcements, not through central bank purchases like gold, but through commercial and industrial imports that quietly drain Western inventories. In 2023, China imported over 200 million ounces of silver. Much of this was for industrial use, but analysts suspect a significant portion went into strategic reserves that China doesn't publicly report. India, the second largest silver consumer, also dramatically increased imports. Indian silver demand reached record highs as consumers and investors sought physical metal. The silver is moving east. It's leaving the COMEX and LBMA systems. It's leaving the transparent, reported inventories. And it's flowing to destinations where Western investors can't easily track it. This creates an uncomfortable possibility. What if the silver that supposedly backs the paper markets isn't really there anymore? What if the numbers we're shown are increasingly disconnected from physical reality? In commodity markets, trust is everything. The moment traders believe the physical metal backing their contracts might not exist, behavior changes. People start demanding delivery instead of rolling contracts. People start pulling metal out of the system. People start hoarding. And we're seeing exactly those behaviors right now. Delivery demands are up. Registered inventories are down. Premiums on physical products remain elevated despite a relatively stable paper price. These are the symptoms of a market where paper and physical are beginning to disconnect, where the price on the screen and the price in the real world are telling two different stories. History suggests this disconnect can persist for months or even years. But when it finally resolves, it resolves violently. The paper price either crashes to reflect the lack of trust, or the physical price spikes to reflect the actual scarcity. Given the industrial demand dynamics, given the structural deficit, given the inventory drawdowns, which direction do you think it resolves? Here's where the story gets uncomfortable for the financial establishment. The major banks that trade silver futures, JP Morgan, HSBC, Bank of America, and others, have historically maintained large short positions in silver. Shorting silver means betting on the price going down. For decades, these institutions made money by managing the paper silver market, writing contracts, providing liquidity, and generally keeping a lid on prices through strategic selling. The mechanics are complex, but the effect was simple. Silver prices were suppressed relative to what pure supply-demand fundamentals would suggest. In 2020, JP Morgan paid $920 million to settle charges that its traders had manipulated precious metals markets for years. The Justice Department documented specific instances of spoofing, placing fake orders to move prices, and then canceling those orders once the price had shifted. This wasn't speculation. This wasn't conspiracy theory. This was a federal settlement based on admitted manipulation. But here's what's changed. Since that settlement, the behavior of major banks in the silver market has shifted dramatically. JP Morgan, once the largest short, has reportedly reduced its short position substantially. Some analysts suggest they've actually moved to the long side, accumulating silver through their COMEX vault holdings. Remember the movement of silver from registered to eligible I mentioned earlier? Much of that movement involves vaults controlled by major banks. Metal is being reclassified, moved, repositioned. The institutions that once profited from suppressing silver prices appear to be positioning for prices to rise. Now, I need to be careful here. I don't have access to their internal trading books. Neither does anyone outside these institutions. We can observe vault movements. We can track public filings. We can analyze the patterns. But we can't definitively prove motive. What I can tell you is this: the pattern of behavior has changed. The institutions that spent decades as aggressive silver shorts are now, at minimum, reducing those positions. At maximum, they may be quietly accumulating. And if the largest, most sophisticated precious metals traders in the world are positioning for higher silver prices, what does that tell you about where prices are likely to go? The parallel to gold is instructive. In 2024, gold broke to all-time highs exceeding $2,400 per ounce. Central banks bought gold at record rates. China, in particular, added to its official gold reserves for 18 consecutive months. Institutions buy gold when they're worried about currency stability. They buy gold when they're worried about inflation. They buy gold when they're worried about the financial system. Gold at all-time highs is a signal. It's the smart money saying something is wrong, something is coming. And silver, historically, follows gold with leverage. When gold moves 10%, silver often moves 20% or more. The gold-silver ratio, currently near 85-1, is historically extreme. For most of history, when this ratio averaged between 15-1 and 50-1, at 85-1, silver is extraordinarily cheap relative to gold by any historical standard. Mean reversion is a powerful force in markets. Ratios that stretch to extremes tend to snap back. And when the gold-silver ratio normalizes, silver outperforms gold significantly. If gold stays at $2,400 and the ratio reverts to a historical average of 50-1, silver would need to reach $48 per ounce. If the ratio overshoots to 30-1, as it did in 2011, silver would reach $80 per ounce. These aren't wild projections. These are mathematical implications of historical patterns. And here's what's most telling. The banks know this ratio math. They've employed analysts studying precious metals for decades. They understand mean reversion. They understand supply-demand dynamics. Their actions, reducing shorts, accumulating physical positions, suggest they expect exactly the reversion we're discussing. They're positioning ahead of retail investors, ahead of the mainstream financial media, ahead of the crowd. The question is whether you position ahead of them. Let me take you back to January 1980. Silver had spent the late 1970s climbing steadily, from 4 per ounce in 1976 to $6 by 1978 to 15s by late 1979. The Hunt brothers were accumulating. Industrial users were hedging. Inflation was raging at double-digit rates. Then, in December 1979, something broke. Soviet troops invaded Afghanistan. Geopolitical uncertainty spiked. Investors fled paper assets for hard commodities, and silver went parabolic. In just 4 weeks, silver went from $16 to $50 per ounce, a 200% plus move in 1 month. Coin shops were overwhelmed. The U.S. Mint couldn't meet demand. People stood in line for hours to buy silver at any price. Now, I'm not predicting an exact repeat. The circumstances are different. But the mechanics of a supply squeeze are remarkably consistent across different assets in different eras. When available inventory gets too low, prices don't rise linearly, they rise exponentially. Small additional buying pressure translates into enormous price moves because there's simply nothing left to sell. In 2011, silver ran from $18 to $49 in approximately 8 months. That was during the aftermath of the 2008 financial crisis, when quantitative easing was in full force and inflation fears were rising. Silver briefly exceeded $50, challenging the 1980 high before the CME raised margin requirements multiple times in quick succession. Traders were forced to liquidate positions to meet margin calls. Silver crashed back to $30, then eventually to $14 over subsequent years. The lesson from 2011 is important. The paper market has mechanisms to arrest price rises. Margin increases, position limits, and other regulatory tools can slow a squeeze or reverse it entirely. But here's what's different about the current setup. In 2011, there was silver to deliver. Inventories were ample. The squeeze was primarily speculative, driven by traders betting on higher prices, not by genuine physical shortage. Today, inventories are depleted. Industrial demand is structural, not speculative. The shortage is real, documented in industry reports and visible in vault drawdowns. You can raise margin requirements to flush out leveraged speculators. But you can't create silver that doesn't exist. You can't deliver metal that's already been consumed by solar panels and electric vehicles. The 2024-2025 setup is more comparable to what happened in palladium between 2016 and 2021. Palladium is used primarily in catalytic converters for gasoline vehicles. Supply comes mainly from Russia and South Africa. And around 2016, the automotive industry realized that supply was falling short of demand. Palladium went from $500 per ounce in 2016 to over $3,000 per ounce by 2022. A 500% increase over 6 years, driven purely by industrial supply-demand dynamics. No speculation, no Hunt brothers. Just a metal that was needed more than it was produced. Silver has the same fundamental setup, industrial demand exceeding supply, inventories drawing down. And unlike palladium, silver has the added dimension of monetary demand. When inflation spikes, when currencies weaken, when financial systems show stress, silver gets bought as a store of value in addition to its industrial consumption. Palladium had one demand driver. Silver has two. Industrial necessity plus monetary hedge. The last time silver had this combination, this dual demand profile during a period of genuine scarcity, was the late 1970s. And we know what happened then. Let's talk about what actually happens if COMEX registered silver gets depleted, because this isn't theoretical anymore. At current drawdown rates, we're looking at potential exhaustion within months, not years. The COMEX has a problem. Their entire business model depends on confidence. Traders need to believe that if they demand delivery, they'll receive metal. Without that confidence, the futures market loses legitimacy. Why trade a contract if you can't trust it'll be honored? Now, the COMEX has never formally defaulted on a delivery. They've come close. In 2021, the silver squeeze nearly broke the system, but they've always found metal somewhere, often paying significant premiums to source it from alternative locations. But finding metal becomes harder as global inventories decline. The eligible category at COMEX isn't automatically available. Those owners have chosen not to make their silver deliverable. To access that metal, COMEX would need to convince or incentivize those owners to reclassify. That typically means paying a premium. What happens when the eligible pool gets drawn down too? What happens when there's simply no more silver in COMEX vaults at any classification? There are several possibilities, none of them good for current price dynamics. Scenario 1, COMEX offers cash settlements at a significant premium to spot. They tell delivery demanders, we don't have the metal, but we'll give you 120% of spot in cash. This would technically avoid default, but would expose the paper-physical disconnect. Prices would spike as traders realize the paper price is fictional. Scenario 2, COMEX implements position limits or liquidation-only trading, similar to what they did to the Hunt brothers in 1980. They changed the rules to prevent further delivery demands. This would crush speculative long positions, but wouldn't solve the underlying supply problem, and it would permanently damage confidence in the exchange. Scenario 3, COMEX sources metal from alternative locations at whatever price necessary. They buy from London, from Asia, from industrial stockpiles. This would require paying significant premiums, and those premiums would eventually filter through to the spot price. Scenario 4, actual default. COMEX simply fails to deliver metal to contract holders who demand it. This is the nuclear option. It would potentially trigger lawsuits, regulatory intervention, an existential crisis for the exchange. It's the least likely scenario, but it's no longer unthinkable given inventory levels. Any of these scenarios leads to higher prices. The only question is how disorderly the adjustment becomes. In an orderly adjustment, silver rises 30 to 50% over the next 12-18 months as the market gradually reprices the shortage. In a disorderly adjustment, silver could spike 100% plus in a matter of weeks as the paper market loses credibility and buyers scramble for physical. The February 2021 silver squeeze gave us a preview. In just a few days, retail investors nearly broke the silver market by buying physical metal and demanding delivery on SLV shares. Premiums spiked, inventories dropped. And then, the situation calmed as the buying pressure subsided. What happens when the buying pressure doesn't subside? What happens when it's not retail investors squeezing for a trade, but industrial consumers desperately needing silver for production? That's not a squeeze. That's a crisis. Given everything we've discussed, what are the practical implications for individual investors? I want to be clear. I'm not a financial advisor. I don't know your specific situation, your risk tolerance, your investment timeline. What follows is educational information, not personalized recommendations. That said, let me walk through how different people are approaching this situation. Physical silver ownership. The most direct way to benefit from a silver shortage is to own silver that you physically possess. American Silver Eagles, Canadian Maple Leafs, Austrian Philharmonics, or generic silver rounds and bars from reputable refiners. Physical silver has no counterparty risk. You don't depend on a bank, an exchange, or a financial institution. If the paper market collapses, your metal is still there. The downside is premiums, storage, and liquidity. You'll pay 15-30% over spot for retail products. You need somewhere secure to keep it. And selling requires finding a buyer willing to pay close to spot. For long-term holders who believe the supply situation will resolve in substantially higher prices, these costs may be acceptable. For short-term traders, they're prohibitive. Silver ETFs with physical backing. ETFs like PSLV, Sprott Physical Silver Trust, hold physical silver in allocated, audited vaults. You can buy and sell shares like any stock. Sprott allows large holders to actually redeem shares for physical metal. PSLV trades closer to net asset value than SLVs and has a better reputation for actually holding the metal it claims. The Royal Canadian Mint audits their holdings. The downside is you're still trusting a financial institution. In a systemic crisis, could the fund be frozen? Could governments confiscate ETF metal? These are extreme scenarios, but they're not impossible. Silver mining stocks. Mining companies offer leveraged exposure to silver prices. If silver doubles, a well-run miner's profits might triple or quadruple, and the stock might move even more. First Majestic, Pan American Silver, Hecla Mining, Core Mining. These are established producers with significant silver exposure. The risks are substantial. Mining is operationally complex. Companies can have accidents, strikes, political problems, management failures. You're not just betting on silver prices. You're betting on a specific company's ability to extract and sell metal profitably. Junior miners and exploration companies offer even more leverage, but with correspondingly higher risk. Many will fail. A few will succeed spectacularly. Silver futures and options. For sophisticated traders, futures and options offer maximum leverage with maximum risk. You can control thousands of ounces with a relatively small margin deposit. But you're playing in the same arena as the banks and institutions we discussed. They have more information, faster execution, and deeper pockets. Most retail traders lose money in futures markets. If you're going to trade futures, understand the mechanics of contango, rollover costs, and margin requirements. Understand that the exchange can change rules at any time. Understand that leverage amplifies losses as quickly as gains. Geographic diversification. Some investors are storing silver outside their home country. Vaults in Singapore, Switzerland, the Cayman Islands. This provides protection against domestic confiscation or capital controls. The costs are higher. The logistics are more complex. But for large holdings, the diversification might be worth it. Dollar cost averaging. Rather than trying to time the bottom, many investors simply buy a fixed amount of silver regularly. $500 per month, $1,000 per quarter. Whatever fits their budget, this smooths out price volatility. You buy more ounces when prices are low, fewer when prices are high. Over time, your average cost tends to be reasonable. What not to do. Don't bet money you can't afford to lose. Silver is volatile. Prices can drop 30% in a week and not recover for years. If you need the money for rent, for medical bills, for education, don't put it in silver. Don't use excessive leverage. The same forces that could make silver spike could also trigger margin calls that wipe you out before the thesis plays out. Don't trust anyone who promises guaranteed returns. This includes YouTube channels, newsletter writers, and especially social media personalities. Everyone has an angle. Everyone is selling something. Do your own research. So when does this play out? When do we see the supply situation reflected in prices? I want to be honest with you. I don't know precisely. Nobody does. Timing markets is extraordinarily difficult, and people who claim certainty are either lying or foolish. What I can tell you is what to watch. The indicators that suggest acceleration is coming. Indicator 1. COMEX registered inventory below 25 million ounces. We're currently just above 30 million. If registered drops below 25 million, the buffer becomes dangerously thin. A few large delivery demands could exhaust available supply. Watch the daily COMEX vault reports. They're published every business day and available on the CME website. Indicator 2. Major delivery month stress. Silver futures have delivery months where contract holders can demand physical metal. March, May, July, September, December. Watch open interest heading into these months. If it stays elevated, if traders aren't rolling positions to later months, that signals delivery intentions. March 2025 and May 2025 are the next major delivery periods to watch. Indicator 3. Premiums spiking on retail products. If coin shops start charging 40 to 50% over spot, it means wholesale markets are stressed. Retail premiums are a leading indicator of physical tightness. Call your local dealer periodically. Ask about availability and premiums. The conversations are informative. Indicator 4. Mining company guidance. If silver miners start reporting declining production or declining reserves, it confirms the supply thesis. Quarterly earnings calls and annual reports contain this information. First Majestic and Pan American both report production numbers. Watch for declines. Indicator 5. ETF flows. If money starts flooding into silver ETFs, it adds to physical demand. These funds must buy metal to back new shares. Large inflows can accelerate the inventory drawdown. Watch SLV and PSLV asset levels. Significant inflows are bullish for the thesis. Indicator 6. Gold-silver ratio movement. If the ratio starts declining from 85, it signals rotation into silver. A move below 70 would confirm the trend. A move toward 50 would represent major silver outperformance. This is a longer-term indicator, but important for confirming the thesis. My personal view, and this is opinion, not advice. I believe the next 12-24 months represent a significant opportunity in silver. The combination of industrial demand acceleration, inventory drawdowns, and monetary uncertainty creates asymmetric upside. Silver could trade sideways and frustrate everyone. That's possible. Markets can remain irrational longer than investors can remain solvent, but the risk-reward seems compelling. If I'm wrong and silver goes to $20, you've lost about 20% from current levels. If I'm right and silver goes to $50 or $100, you've made 100-300%. That asymmetry is why I own silver. That asymmetry is why I'm making this video. Not to guarantee anything, not to predict the future, but to share the analysis that leads me to a particular conclusion. You have to make your own decision. Let me bring this back to where we started. 73% of COMEX registered silver has disappeared. The vaults that back the paper market are draining. Industrial demand is accelerating. Mine supply isn't keeping up. And the institutions that have managed this market for decades are quietly repositioning. This isn't theory. These are numbers from official reports. You can verify them yourself. COMEX publishes vault data daily. The Silver Institute publishes annual supply-demand studies. Mining companies file quarterly production reports. The information is there. It's just not being talked about on financial television because the implications are uncomfortable. If silver is genuinely scarce, if the paper market is genuinely vulnerable, then a lot of people are about to lose money betting on the wrong side. And those people advertise on financial television. So the story doesn't get told. The dots don't get connected. And retail investors stay in the dark while institutions reposition. That's why channels like this exist. That's why I spend hours reading vault reports and mining filings and regulatory documents. Because someone needs to synthesize this information. Someone needs to present it in a way that's accessible. I don't have a newsletter to sell you. I don't have a paid subscription tier. I don't have a silver company sponsoring this video. What I have is analysis based on public data, presented as clearly as I know how. If you found this valuable, subscribe to the channel. Hit the notification bell so you see future videos. And share this with someone who needs to see it. Someone who has savings they're worried about. Someone who is looking for alternatives to a financial system that seems increasingly unstable. The silver situation will resolve. It always does. Either prices rise to attract more supply and reduce demand, or the paper market breaks and resets at a new equilibrium, or some combination of both. The question is whether you're positioned before that resolution or after. Drop a comment below. Tell me what you think. Tell me if you're buying silver or if you think this analysis is wrong. Tell me what you want me to cover in future videos. This is Finance Market News. Thank you for watching, and I'll see you in the next one. Stay tuned for our next video breaking down the Fed's latest meeting and what it means for precious metals. If you want to be notified when that drops, make sure you're subscribed with notifications enabled. And remember, the biggest moves in markets happen when consensus is wrong, when everyone believes one thing and reality is different. Right now, consensus says silver is boring, that it's a sleepy metal that trades in a range. The vault data tells a different story. The question is, which story you believe. I'll see you next time.